So, picture this. You are just sitting on your couch, right? Minding your own business, scrolling through your phone.
Like we all do, yeah.
Exactly. And suddenly you see a post from a guy you went to college with. You know, the guy who definitely copied your homework in macroeconomics.
Oh, everyone knows that guy.
Right. And he is just casually bragging with a screenshot that his stock portfolio is up like 30% this year. 30%.
Which is a massive number.
It is. And you stare at that number, and then you look at your own savings account, which is paying, what, a fraction of a percent, and you get this cold knot of anxiety right in your stomach.
Oh, yeah, that visceral reaction is it's totally universal.
You just think to yourself, like, I'm falling behind. I need to get into the market right now.
Yeah, it's this really potent, highly toxic cocktail, honestly. It's the fear of missing out, mixed with this very real kind of creeping sense of financial stagnation. Because, people realize they cannot just save their way to wealth anymore, so they turn to the market.
So you're riding that wave of panic-induced motivation, right? You open up your app store, you download one of those sleek, um, gamified brokerage apps, you link your checking account, and you are ready to build an empire.
Ready to conquer Wall Street.
Exactly. But then you actually tap into a stock profile, and you are just immediately assaulted by a wall of acronyms and data.
Just a sea of numbers.
Yeah, you're staring at PE ratios, market caps, EPS, dividend yields, bull markets, bear markets, 50-day moving averages, and all that motivation just hits a brick wall.
Completely evaporate.
You freeze, you close the app, and you tell yourself the absolute greatest lie in personal finance, which is, I'll figure this out later.
And later is a horizon you basically never actually reach.
Mm.
But what is really crucial to understand here is that your paralysis in that specific moment, it is not a personal failure.
It feels like one, though.
It does, but you didn't freeze because you're incapable of understanding the math, right? You froze because the language of the stock market operates as this, highly intentional psychological barrier. I mean, it is a moat built around the castle of wealth.
Wow, a moat. And that moat is exactly what we are draining today. Our mission for this deep dive is to completely dismantle this entire ecosystem of jargon, because the true cost of that intimidation is just catastrophic for the average person.
It really is.
I mean, we're pulling from a bunch of sources today, and the National Financial Educators Council recently quantified this, and the numbers are honestly nauseating. They found the average American is losing about $1,500 a year purely due to a lack of basic financial literacy.
Yeah, and let's scale that number out a bit to really understand the gravity. Because $1,500 this year might just feel like you need to skip a vacation or just eat at home more often.
Right, it stings, but it's not life-ruining.
Exactly. But stretch that over, say, a 12-year period. You are looking at $18,000 in 12.
18 grand.
Yeah, I mean, that is a reliable used car. That is half a down payment on a house in a lot of markets.
Yeah.
And it's just being left on the table because the financial industry thrives on acting as this highly compensated gatekeeper to your own money.
Right, because if they can convince you that it requires like a PhD to buy a stock, you will happily pay them a massive fee to just do it for you.
Exactly.
So today we take the keys back. Let's just start at the literal bedrock. We need to completely rewire how we view a stock in the place, because for a beginner, a stock is just a three-letter ticker symbol blinking green or red on a screen.
Yeah, it feels like pulling the lever on a digital slot machine.
Exactly like a slot machine.
And we have to completely sever that association.
Hmm.
At its most fundamental, irreducible level, right? A stock is literal ownership in a legal business entity. When you purchase one share of Apple, you are not buying some digital trading card. You're purchasing a legally binding fractional ownership stake in the intellectual property, the glass storefronts, the actual inventory of iPhones, and most importantly, the future cash of Apple Incorporated.
Okay, let's unpack this, because I think people nod along to the word ownership, but they don't actually internalize the mechanics of it.
Right.
Like if I have 10% stake in my neighborhood bakery, I instinctively understand how that works. If the baker sells out of croissants by 9 a.m. every day, I make a profit.
Yeah.
If the commercial oven catches fire and needs replacing, I take a financial hit. I'm tied to the physical reality of that business.
Yes. And that is the exact psychological shift required to succeed in the public markets.
Yeah.
You are moving from like a gambler who's just hoping a line chart go to a calculated assessment.
So I have to think like a partner.
Exactly. You are looking at a company and basically stating, based on the products they sell and the management team they have, I believe this enterprise will generate more cash in 5 years than it does today.
So I buy into this bakery, or, I buy a share of Microsoft, it into cash in my pocket. Like, how do I extract the value of that ownership?
So the mechanics of return come in two specific forms. The first one is capital appreciation. This is the mechanism pretty much everyone is vaguely familiar with.
The buy low, sell high thing.
Right. If you buy your slice of the business for $100 and the company doubles its customer base over the next 3 years, the intrinsic value of the enterprise has grown. So someone else looking at that success will be totally willing to pay you $150 for your ownership slice.
Oh, okay.
You sell, and you realize a $50 profit.
Classic. So what?
The second mechanism is the dividend. Now, a dividend is a literal cash distribution from the company's profits directly back to the owners.
Okay, wait, explain that with the bakery.
Sure, so if your neighborhood bakery makes a $10,000 profit at the end of the year, the owners might decide, hey, let's keep $5,000 in the bank for a new oven, and we'll distribute the other $5,000 to ourselves.
Right.
If you own 10% of the bakery, you get a check for $500. It is literally your contractual cut of the...
Okay, the total logical sense for a physical business. But I have to ask, buying a stock is just this sober, calculated business transaction. Why does the modern stock market look like an absolute circus?
Well,
I mean, you have teenagers on Reddit throwing their college tuition into companies that are actively going bankrupt purely because a CEO posted like a meme on social media. That isn't evaluating a balance sheet. That is a casino.
you're not wrong. The market is this massive ecosystem that houses both investors and speculators simultaneously.
Yeah.
And the dynamic you were describing there, that is pure speculation.
Speculators.
Yeah. Speculators, they do not underlying business is profitable or even if it will exist in 5 years. They are entirely focused on short-term psychological impulses of other traders.
Like trying to read the crowd.
They are playing a mat of hot potato. They're hoping to be a worthless asset and sell it to a greater fool before the stops.
And occasionally, one of them gets lucky, posts that percent gain on social media, and makes everyone else feel like they're doing it wrong.
Which is the ultimate trap, right? Because historically, the speculators are the ones who get completely wiped out during market corrections. True wealth generation is honestly incredibly boring.
Boring is good.
Boring is great.
Mm-hmm.
It is the wealth builders, the people operating with that neighborhood bakery ownership mentality, who compound their money over decades while the speculators just churn their accounts to zero.
But even if a beginner adopts that wealth builder mindset, they still have to interact with the pricing on the app. Which brings us to perhaps the most pervasive illusion in finance, and that is the price tag fallacy.
Oh, it is an almost inescapable mental hurdle.
I mean, think about it. You open your app, you want to buy a car company, you see company A is trading at $100 a share. You scroll down, you see company B is trading at $10 a share.
Right.
Every single instinct in the human brain screams that company B is a massive bargain. You think, it's only $10. I can buy 10 times as many shares.
Because the human brain maps stock prices to retail shopping. If two televisions look exactly the same and one is 90% cheaper, you buy the cheap one.
Obviously.
But in equities, that assumption is mathematically meaningless. A stock's price, viewed in isolation, provides zero information about the value of the company or whether the stock is cheap.
Because we are missing the second half of the equation, right? We need to introduce the concept of market capitalization, or market cap.
Let's really break down the mechanics here.
Gladly. Market cap is the total absolute value of the entire company. Like if you want to single and buy every desk, every patent employee, the market cap is the price you would pay.
And the formula to find it is really simple. You multiply the current share price by the total number of shares that exist.
Let's use identical companies to illustrate this just so you can really see it. Imagine Company A and Company B both manufacture identical shoes, they make the exact same profit, and the market decides both companies are worth exactly $1 billion.
Perfect. So we have two $1 billion market caps. Now, the board of directors at Company A decides they want to cut their company into 10 million individual ownership slices or shares.
Okay.
You divide the $1 billion value by 10 million shares, and the market prices each individual share at $100.
Right. Meanwhile, the board at Company B decides they want to cut their exact same billion-dollar company into 100 million tiny slices.
Yeah.
So 1 billion divided by 100 million means each share trades at $10.
Exactly. Company B is not cheaper. It is just cut into smaller pieces. A $10 share of Company B buys you a microscopically smaller percentage of the overall business than a $100 share of Company A.
So if I order a large pizza and cut it into 4 massive slices, and you order the exact same large pizza and cut it into 40 tiny slivers, you don't have more food just because you have 40 pieces.
No, you just have a messier pizza.
Right. The total caloric value, the market cap, is identical.
That analogy holds up perfectly.
Yeah.
And understanding this completely changes how you view the different tiers of the stock market. Because companies are grouped by these market caps, and those groupings really dictate how much risk you are taking and how much growth you can realistically expect.
Yeah, so the standard tiers usually start at small cap, which is a company worth between $300 million and $2 billion. Then mid cap up to $10 billion. Large cap over $10 million. And finally, the mega caps, the titans of industry worth over $1 trillion, like Microsoft or Alphabet.
And where beginners really fail is assuming all these tiers operate by the same physics. A beginner will look at Apple, which is, roughly a $3 trillion company, and they think, I want this to double so I can turn my $5,000 into $10,000.
Well, wait, what's wrong with wanting Apple to double? Everyone wants their money to double.
Because of the law of large numbers. For Apple to actually double its stock price, its market cap has to go from $3 trillion to $6 trillion.
That's wow.
Right. That's to single-handedly generate $3 trillion of new, unprecedented global economic value. It would have to invent an entirely new technological paradigm, like a consumer-ready quantum computer or, a viable humanoid robot, just to move the needle that drastically. It is mathematically grueling.
But a small-cap company, say a regional software firm worth $500 million, if they just managed to sign 3 major national contracts next year, their value could easily double to $1 billion.
Exactly. The room for exponential growth is vast in the small-cap space, but, and this is a huge but, the risk of bankruptcy is equally massive. A $500 million company can get wiped out by a single bad product launch.
Oh, for sure.
Whereas Apple could release 3 terrible iPhones in a row and still have $100 billion in cash lying around to survive. So you trade that explosive growth potential for sheer survivability.
Okay, so the share price is just the size of the pizza slice, and the market cap is the size of the whole pie. But let's look under the hood. Who is actually setting these prices second by second? Like, if I want to buy that slice of Apple, how does the transaction physically happen?
It happens through the exchanges, the plumbing of the global financial system. The 2 dominant arenas in the United States are the New York Stock Exchange, or NYSE, and the NASDAQ.
NYSE is the classic visual, right? Like the chaotic trading floor on Wall Street, people in color-coded jackets screaming and throwing hand signals.
Yeah, though it's mostly digitized now, yes, it definitely has that historical legacy. The NASDAQ, on the other hand, never had a physical trading floor. It was built from the ground up as a decentralized network of computer servers, basically matching buyers and sellers electronically.
But for the guy sitting on his couch with his app, whether his stock is routed through a server in New Jersey for the NASDAQ or a server downtown for the NYSE is practically irrelevant.
Completely irrelevant to him.
What matters is the service those exchanges provide, which is a concept called liquidity.
Liquidity is the absolute lifeblood of investing. It basically measures how quickly and efficiently you can convert an asset into cold, hard cash without having to slash the price.
Think about real estate for a second. If you own a massive, custom-built mansion in a tiny rural town where nobody wants to live, you are illiquid.
Very illiquid.
You might be a millionaire on paper, but if you have a medical emergency and need $50,000 in cash by Friday, you are in trouble. You cannot sell a house in 3 days unless you drop the price by half. You are trapped in the asset.
And the stock exchanges exist exactly to prevent you from being trapped. By centralizing all the global buyers and sellers into one massive digital pool, they basically guarantee that the millisecond you hit the sell button on your Apple stock, there is an algorithmic buyer on the other side of the planet ready to take it off your hands for cash.
But what actually forces the price from $100 up to $101? Like, who decides that?
It's the purest distillation of supply and demand. If a company announces a breakthrough medical device, suddenly millions of people want to buy the stock. But the current owners know about the device too, so they refuse to sell at the current price.
They hold the shares hostage.
Exactly. So the buyers are forced to systematically raise their bids. They offer 101, then 102, just inching the price up until it reaches a number high enough to finally tempt an owner into selling. The price physically moves up the ladder of demand.
And the mechanism we use to interact with this ladder is where beginners so often shoot themselves in the foot. When you open your app and just hit the big green buy button, you are usually submitting what is called a market order.
Yes. And a market order is a blunt instrument. It basically tells your broker, I want 100 shares of this company right this second, and I do not care what price you have to pay to get them. Just execute the trade.
Which is perfectly fine if you are buying a mega cap stock where millions of shares trade every single minute. But what happens if you use a market order on a tiny small cap stock that hardly anyone is trading?
You wildly expose yourself to sudden volatility. Let's say you see a small cap stock trading at $10. You hit a market order for 100 shares, expecting a $1,000 charge.
Right.
But in the half second it takes your data to reach the exchange, a massive institutional buyer sweeps in and buys up all the available shares at $10.
The supply vanishes.
The supply vanishes, and the next available seller isn't willing to part with their shares for less than $12. Yeah, and because you used a market order, which prioritizes speed over price, your broker just happily buys those shares at $12.
Oh, no.
You intended to spend $1,000, but your account is drained of $1,200. You instantly lost $200 of purchasing power just to the mechanics of the trade.
This is exactly why the limit order is so crucial. It acts as a safety net.
A limit order allows you to dictate the absolute maximum price you are willing to pay. You tell the broker, I want 100 shares, but I will not pay a single penny over $10.50.
So if the price spikes to $12,
your order simply sits there, unfilled. You do not get the shares, but your capital is protected.
But even with a limit order protecting you from massive spikes, there is a hidden tax on every single trade you make. A friction cost built into the system called the bid-ask spread.
Ah, the spread. This is how the middlemen, the market makers, generate billions of dollars.
I always picture the spread like a used car dealership.
That's a great way to look at it.
Yeah, like if I drive my car onto the lot and say I want to sell, the dealer might offer me $5,000. That is his bid. If I refuse, walk away, and come back the next day deciding I actually want to buy that exact same car back off the lot, the dealer will look at me and say the price is $6,000. That is his ask.
The $1,000 difference is the spread. The dealer buys at the lower bid and sells at the higher ask, pocketing the difference just for providing the convenience of the lot.
The stock market operates exactly the same way. When you buy a stock, you are forced to pay the higher ask price. When you sell that stock a minute later, you are forced to accept the lower bid price.
And for a highly liquid company, that spread might be a single penny.
Huh.
But for smaller companies, the spread could be 50 cents or even $1.
Which means the second you buy a stock, your account is immediately in the red. You have to wait for the stock to appreciate just to cover the cost of the spread.
Right.
So if I'm losing money to the spread the second I hit buy, doesn't that make day trading basically impossible for a regular person? Like, if day traders are buying and selling 30 times a day, they are paying that dealership markup over and over and over again. It feels like death by 1,000 cuts.
It absolutely is. And this is exactly why day trading is a losing game. You are fighting the spread on every single trade. The mechanics of day trading are designed to drain retail capital through friction. And, the stress of constantly battling those mechanics inevitably leads to the true destroyer of wealth, which is human psychology.
Right. This is where we shift from math to behavioral science, because the market isn't just a calculator, it's a mirror reflecting our deepest evolutionary flaws. We need to talk about the emotional roller coaster of bulls and bears.
Absolutely. So a bull market is broadly defined as a period where the market rises 20% or more from its recent lows. It is a period of economic expansion, optimism, and honestly, greed.
And a bear market?
A bear market is the inverse, a 20% drop from recent highs, marked by contraction, pessimism, and fear.
What's wild to me is the historical disparity between the two. When you look at the First Trust data, the average bull market lasts around 4.5 years and generates cumulative gains of over 150%.
That's huge.
Right. But the average bear market lasts less than 10 months and results in an average drop of about 32%.
The data presents a very clear reality here. The market spends significantly more time expanding than contracting, and the upward trajectory drastically outpaces the downward corrections.
Yet, if you talk to the average person, they act as if the bear market is the default state of the universe. Why do we completely ignore a half decade of massive gains, but completely lose our minds over 9 months of losses?
Because we are fighting millions of years of evolution. The phenomenon is called loss aversion. The human brain is hardwired by the amygdala to process the pain of losing something roughly twice as intensely as the pleasure of gaining that exact same thing.
Ah, because thousands of years ago, gaining an extra apple was nice, but losing your only apple meant you starved to death.
Precisely. We are optimized for survival, not compound interest. Gaining 30% in your retirement account over 2 years feels, satisfying. But watching your account drop 30% in 3 weeks, that triggers an acute physical fight-or-flight response. Your brain does not distinguish between a red arrow on an app and a physical predator in the woods,
And the flight response in this scenario means mashing the sell button.
which is the most catastrophic action possible.
Uh,
By selling in a panic, you take a temporary, unrealized drop in value and legally convert it into a permanent mathematical loss of capital.
Researchers at Delbar actually tracked this behavior over a 20-year period. They found that while the broader S&P 500 generated an average annual return of 7.2%, the average individual investor only managed a 5.5% return.
They underperformed the very assets they were buying.
Yes, because they tried to outsmart the system. They sold at the bottom when they were terrified, waited for the market to feel safe again, and bought back in at the top. That behavior cost them nearly 2% a year.
And 2% compounded over decades is literally the difference between retiring in comfort and working until you are 80. There's another study from Charles Schwab that tracked accounts after the 2008 financial crisis.
Oh, this one is fascinating.
Right. The investors who held their breath and stayed invested through the crash saw an average return of 8% over the following decade. The people who panicked sold everything to cash and hid under their mattresses. They earned effectively zero, missing the greatest bull run in history.
Okay, I hear the statistics, and the math is undeniable. But let's be real for a second. We are sitting in a studio, calmly analyzing data from 2008. But imagine being a 50-year-old in that crash, watching half your life savings vaporize in a month. It's easy to say don't panic in hindsight, but when you see your life savings drop by a third, isn't selling just basic human survival instinct?
Yes, it is. But you cannot rely on willpower to overcome millions of years of evolution. Willpower breaks under pressure. The only way to counter the panic is to have an unbreakable conviction in what you actually own. Yeah. If you bought a stock because a teenager on Reddit said it would go up, you will panic when it drops. But if you bought a stock because you thoroughly analyze the underlying business and know it generates billions in free cash flow, you view the price drop not as a threat, but as a temporary mispricing.
Since our survival instincts make us terrible traders, how do we use actual math to determine if a company is worth buying in the first place? Which brings us to fundamental analysis. How do we measure the health of the underlying business?
The foundational metric for this is the PE ratio, or price-to-earnings ratio. But before we even touch PE, we have to define the E. We need to understand EPS, earnings per share.
Okay, break EPS down like I'm 5 years old.
Imagine our billion-dollar company that has 100 million individual shares. At the end of the year, after paying the employees, the rent, and the taxes, the company has exactly $200 million of pure profit left over. To find the EPS, you divide that $200 million of profit by the 100 million shares.
So the EPS is $2, meaning for every single slice of the pizza I own, my slice generated exactly $2 of pure profit this year.
Exactly. EPS is the actual engine of value. Now, the PE ratio simply compares that engine to the price tag. If the stock is currently trading at $50 a share and the EPS is $2, you divide 50 by 2. You get a PE ratio of 20.
What does the number 20 actually mean in reality?
It means investors are currently willing to pay $20 today for the right to receive $1 of that company's current annual profit. Alternatively, you can think of it as a payback period. If the company's profits stay exactly the same, it would take 20 years for the company to generate enough profit to equal the price you paid for the stock.
So obviously a beginner looks at this and thinks, I want the lowest PE possible. Why would I pay $20 for a dollar of profit when I can find a stock with a PE of 5 where I only pay $5 for that same dollar of profit?
Because a low PE is often a massive flashing warning sign. A PE of 5 doesn't necessarily mean the stock is on sale. It usually means the broader market believes the company's earnings are about to collapse.
Oh.
Imagine a company that makes physical DVD players. Their profits this year might look great, resulting in a low PE, but institutional investors know streaming is destroying their business model. No one wants to buy a dying business, so the price drops, compressing the PE ratio. The low PE reflects pessimism, not value.
And on the flip side, you look at tech companies with PE ratios of 80 or 100. A beginner thinks they're absurdly overpriced.
But a PE of 80 implies extreme optimism. The market is happily overpaying for today's profits because they expect those profits to quadruple in the next 3 years due to artificial intelligence or cloud computing.
This highlights the most jarring realization for a new investor. The stock market does not care about the present. It is a forward-looking discounting mechanism. It trades entirely on the expectations of the future.
This is the exact mechanism that causes a stock to plummet even after a company announces record-breaking profits. A company might proudly report, "We generated $2 billion in profit this quarter," and the stock instantly crashes 10%.
The beginner is bewildered, like, they made $2 billion. How is that bad?
Because Wall Street analysts had modeled out the business and collectively expected them to make $2.2 billion, the stock was already priced for perfection. When the reality fell short of the expectation, the market had to aggressively reprice the asset downward, despite the absolute number being highly profitable.
Okay, let's look at another fundamental concept that beginners notoriously misunderstand, and that is dividends. On the surface, a dividend feels like the ultimate hack.
It feels like the company is just dropping free money into your account for being a loyal shareholder.
Right. You own 100 shares of a stock trading at $50. The company announces a $1 dividend per share. The next day, you wake up and there's $100 of cash sitting in your brokerage account. It feels like magic.
But here's where it gets really interesting. The illusion of free money vanishes when you understand the mechanics of the ex-dividend date. Let's trace the actual flow of capital.
Let's do it.
The company has a massive corporate bank account holding millions in cash. They decide to pay a $1 dividend per share. On the ex-dividend date, the company literally wires that cash out of its corporate account and disperses it to the millions of shareholders.
The cash physically leaves the building.
Exactly. And because that cash has left the building, the fundamental value of the company is now objectively lower. The company is poorer by the exact amount of the dividend. Therefore, the stock exchange automatically adjusts the share price downward by the exact amount of the dividend.
Wait, really? So if it closed at $50 on Monday and paid a $1 dividend, it forcibly opens at $49 on Tuesday?
Yes, you did not gain any wealth. You simply had $1 of your equity converted into $1 of taxable cash. It is a forced partial liquidation of your asset.
If it's a forced liquidation, why is dividend investing so popular?
Because a company that can consistently pay and grow its dividend over decades is demonstrating massive financial resilience. It means they are generating so much excess cash flow, they don't even know how to spend it all on research and development. It provides a psychological anchor during bear markets. Even if the stock price drops, you are still receiving cash flow.
But there is a lethal trap here, the dividend yield trap. The yield is just the annual dividend divided by the share price. If a $100 stock pays a $5 dividend, it has a 5% yield.
A respectable number.
But what if the company is caught in a massive scandal, they lose half their customers, and the stock price collapses from $100 down to $25? If they haven't officially cut the dividend yet, that $5 payout on a $25 stock suddenly registers on the app as a 20% dividend yield.
And the algorithm pushes it to the top of the highest yielding stocks list, and beginners flock to it.
I always compare this to being on a sinking cruise ship and everyone is fleeing to the lifeboats. But you decide to board the ship because you heard the buffet is serving free lobster.
That's hilarious.
The 20% yield is the lobster. You are buying a dying, fundamentally broken company just to capture a dividend that the board of directors is almost certainly going to cancel next week to save the business from bankruptcy.
An exceptionally dangerous trap. Now, there is a second way companies return value to shareholders, and it is largely invisible to the retail investor, and that is stock buybacks.
Buybacks have become the dominant way companies use their cash, and they are highly controversial. Walk us through the physical mechanics of a buyback.
Instead of wiring the excess cash to your brokerage account and forcing you to pay taxes on a dividend, the company takes its billions in cash, goes onto the open exchange, and physically buys its own shares back from anyone willing to sell. Once the company owns those shares, they cancel them. They permanently delete them from existence.
They're throwing slices of the pizza in the trash.
By deleting those shares, the total number of outstanding shares shrinks. Let's look at the math. If a company earns $10 million in profit and there are 10 million shares, the EPS is $1. But if the company buys back and deletes half of all shares, there are now only 5 million shares left. That same $10 million of profit is now divided by 5 million shares. The EPS instantly jumps to $2.
And because the EPS doubled, the stock price inevitably goes up. My individual slice of the pie became more valuable, representing a larger ownership stake in the company, and I didn't have to do a single thing.
It is the most tax-efficient way to compound wealth for long-term holders. But, as you noted, it is highly scrutinized. The pushback is ideological. Critics argue that a company using billions to artificially shrink its share count and boost the stock price, and by extension boost executive bonuses, is a gross misallocation of capital. They argue that cash should be deployed into the real economy, building domestic factories, heavily funding R&D, or raising the median wage of their workforce.
Right. It is the ultimate debate between prioritizing shareholder value versus stakeholder value. And we aren't taking a side on that here. We're just explaining the mechanism.
Exactly. Regardless of where you fall on the ethical spectrum of that debate, as an investor, you must recognize that buybacks are a primary engine of modern market returns.
Okay, I want to take a breath here and step into the shoes of the listener. We have covered calculating market cap, battling the bid-ask spread, overriding our evolutionary fear of bear markets, evaluating PE ratios, tracking ex-dividend dates, and monitoring buybacks. If I am a beginner with a full-time job and a family, I am listening to this and thinking, I do not have the time or the financial modeling skills to do this. I'm just going to keep my money in a savings account.
And that is the exact moment the financial industry usually swoops in and says, don't worry, we will do it for you for a small fee. But you don't need them, because there is a profound cheat code in modern finance. It is an innovation that fundamentally democratized wealth creation, and that is the index fund.
The index fund, John Bogle's masterpiece. Explain how this fundamentally changes the game for the beginner.
When you try to pick an individual stock, you are betting that you can find the needle in the haystack. You're taking on immense company-specific risk. If you buy a supposedly great company and the CEO is caught committing massive accounting fraud, the stock goes to zero and your capital is incinerated.
An index fund solves that by just buying the entire haystack.
Precisely. The most ubiquitous example is the S&P 500 index fund. This single fund pools the money of millions of investors and uses it to systematically buy shares in the 500 largest, most profitable publicly traded companies in the United States. Apple, Microsoft, Amazon, Berkshire Hathaway, Johnson & Johnson, all of them simultaneously.
When you buy one single share of an S&P 500 ETF and exchange-traded fund for maybe $400, you are instantly securing microscopic fractional ownership in all 500 companies.
It provides immediate, bulletproof diversification. If one of those 500 companies goes bankrupt tomorrow, it is effectively a rounding error in your portfolio. The loss is completely absorbed and overwhelmed by the growth of the other 499 companies. You're no longer betting on the competency of a single CEO. You're betting on the relentless, overarching forward momentum of the American macroeconomic engine.
But here is the inevitable pushback from the listener. They think, okay, an index fund is safe and boring, but if I want to get rich, shouldn't I hire a professional? Shouldn't I give my money to an actively managed mutual fund where a guy with a Harvard MBA and a team of analysts picks the absolute best stocks for me?
That is the narrative the financial industry spends billions of dollars advertising. But the empirical data destroys that narrative. S&P Global conducts a recurring study called the SPVA scorecard. Over a recent 15-year period, they found that nearly 90% of actively managed large-cap mutual funds completely failed to beat the simple, dumb, automated S&P 500 index fund.
Wait, hold on. Let's let that sink in. If professional stock pickers whose full-time job is beating the market fail 90% of the time, is the whole mutual fund industry basically a scam to collect that 1% fee?
It is certainly the great humiliation of Wall Street. And the reason they underperform is largely due to the anchor they attach to their own funds, their fees. Specifically, the expense ratio.
The expense ratio is the silent killer of wealth. Let's tear this down, because people don't understand how percentage fees compound. An index fund might charge you an expense ratio of 0.03%, basically free. An actively managed mutual fund will charge you, let's say, 1%.
To a beginner, 1% sounds negligible. It sounds like a minor sales tax.
Right. They think, well, if the expert makes me 10% and takes 1%, I still get 9%. Who cares? But let's run the actual math on a long-term timeline. Imagine you invest $10,000, you leave it alone for 30 years, and the market returns 7% annually.
A standard conservative projection.
If you are in the nearly free index fund, your $10,000 compounds into roughly $72,300. But if you put that same money into the actively managed fund, charging a 1% fee, generating that exact same return, you end up with only $57,400.
You lost nearly $15,000.
You sacrificed a massive chunk of your total final wealth to pay a fee that sounded like a rounding error. Because they don't just take 1% of your profits, they extract 1% of your entire total account balance every single year, regardless of whether the fund gained money or lost money that year. As your account grows, the absolute dollar amount they siphon off grows exponentially.
And that is exactly why Warren Buffett, the single greatest active stock picker in human history, directed that upon his death, 90% of his wife's inheritance should be placed not in a hedge fund, but in a rock-bottom, low-cost S&P 500 index fund. The math of fee drag is insurmountable.
So if stock picking is a fool's errand and active management drains your wealth, what actually dictates how much money you make?
A landmark academic study by Brinson, Hood, and Biebauer analyzed the performance of massive pension funds. They found that over 90% of the variability in a portfolio's returns was not dictated by which specific stocks they picked, or when they tried to time the market. Over 90% of the outcome was determined by one single macro decision: asset allocation.
Asset allocation.
Yeah,
Basically how you divide your pie between completely different asset classes.
exactly. The fundamental decision of how much money you allocate to the aggressive growth engine of stocks versus the stable, income-producing anchor of bonds.
Let's define a bond quickly just to contrast it with a stock.
If a stock is ownership, a bond is a loan. When you buy a bond, you are lending your cash to a corporation or the federal government. They promise to pay you a fixed interest rate every year and return your original principal on a specific date. Because you are legally owed that money, bonds are vastly less volatile than stocks. But because they're safer, their long-term returns are significantly lower.
So asset allocation is dialing in your personal risk tolerance. If you are 25 years old, you have 4 decades for your money to grow. If the stock market crashes 50% tomorrow, it literally does not matter because you don't need the money to buy groceries. You can afford to be aggressive, maybe an allocation of 90% stocks and 10% bonds.
But if you are 62 years old and retiring in 3 years, a 50% market crash would destroy your retirement plans. You cannot afford that volatility. Yeah. So you shift your allocation to a defensive posture, perhaps 60% bonds and 40% stocks. You sacrifice top-end growth to guarantee the preservation of your capital.
And within that stock allocation, you need actual diversification. A lot of beginners suffer from what I call fake diversification.
I see this constantly. A beginner will buy shares in Apple, Microsoft, Nvidia, Meta, and Alphabet. They look at their app and say, "Look how responsible I am. I own 5 different companies."
But they are all massive tech companies. If Congress passes aggressive antitrust legislation or the semiconductor supply chain collapses, all 5 of those stocks are going to crater at the exact same millisecond. You aren't diversified. You are highly concentrated in one sector.
True diversification means spreading capital across the different sectors of the macroeconomy. The S&P 500 naturally does this. You own tech, yes, but you also own financials like banks, healthcare like pharmaceuticals, and consumer staples.
Consumer staples are the unsung heroes of a portfolio.
They are the ultimate defensive play. Consumer staples are companies that make toothpaste, toilet paper, laundry detergent, basic groceries. During an economic boom, consumer discretionary stocks like luxury cruise lines and high-end auto manufacturers soar. But when a brutal recession hits, people cancel their cruises and stop buying sports cars.
But no matter how bad the recession gets, people still brush their teeth and wash their clothes. The revenue of consumer staples companies remains incredibly resilient, providing balance to your portfolio when tech is bleeding.
Correct. So we now have the vehicle, a low-cost, broadly diversified index fund with an age-appropriate asset allocation. The next logical question is, what's the best way to drive it over the long haul?
This brings us to the operational systems, starting with dollar cost averaging, or DCA. This is the ultimate behavioral hack to defeat the amygdala panic we talked about earlier.
Dollar cost averaging removes the human element of decision-making entirely. You commit to investing a fixed dollar amount at a fixed interval, regardless of market conditions. For example, you automate your account to buy $500 of your index fund on the first of every month.
And the math behind this is brilliant. Because the dollar amount is fixed, the number of shares you buy automatically adjusts based on the price.
Exactly. When the market is in a raging bull run and prices are at all-time highs, your $500 naturally buys fewer shares. You're automatically buying less when assets are expensive. But when the market crashes and everyone else is panicking, your automated system takes that same $500 and buys significantly more shares because they are effectively on clearance.
It forces you to buy the dip without requiring any willpower.
And more importantly, it cures the paralysis of market timing. Beginners agonize over when to invest. If the market is at an all-time high, they hold their cash because they fear a drop. If the market is crashing, they hold their cash because they fear it will drop further. They sit in cash forever. DCA liberates you from having an opinion on the daily news cycle. You just execute the system.
And that relentless execution feeds the most powerful force in finance: compound interest.
Compounding is the process of your money generating returns, and then those returns generating their own returns. It is an exponential snowball.
If you invest $10,000 at a 10% return, you make $1,000 in year one. You now have $11,000. In year two, you don't make $1,000, you make $1,100 because that first $1,000 is now working for you as well.
And the single most vital ingredient for compound interest is not the amount of capital or the rate of return, it is time. To illustrate this, let's trace the financial lifespans of person A and person B.
I love this thought experiment because it proves how punishing delay can be. Person A is incredibly disciplined early on. They start investing at age 25. They put $5,000 a year into the market for 10 straight years. At age 35, they stop. They never invest another penny. Their total out-of-pocket contribution is $50,000.
Person B takes a different path. They spend their 20s procrastinating. They wait until age 35 to start investing. But to make up for lost time, they invest aggressively. They put in $5,000 a year every single year for 30 straight years until they retire at 65. Their total out-of-pocket contribution is $150,000, 3 times as much as person A.
But when they both hit age 65, assuming the same 7% average market return, the outcome is shocking. Person B, who diligently invested $150,000, ends up with a very respectable $550,000. But person A, the one who only put in 50 grand and stopped 3 decades ago, they end up with over $620,000.
Person A contributed a third of the capital, but generated significantly more total wealth. Why? Because that initial $50,000 had a 10-year head start to compound. By the time person B even started, person A's money was already generating massive returns on its own returns. You can never hustle hard enough in your 40s to regain the compounding time you wasted in your 20s.
It is the ultimate mandate to start right now. But as that massive snowball grows, you have a silent partner who wants a cut: the IRS. We need to talk about tax efficiency because how you trade dictates how much you keep.
The tax code is fundamentally designed to reward long-term stability and punish short-term speculation. This is governed by capital gains taxes. A capital gain is simply the profit you realize when you sell an asset for more than you paid for it.
And the IRS differentiates heavily based on a 1-year timeline.
Crucially, if you buy a stock, it goes up, and you sell it after holding it for 11 months, that is a short-term capital gain. The IRS views that profit the exact same way they view the salary from your day job. It is taxed at your ordinary income tax rate, which, depending on your tax bracket, could be up to 37%.
If you are day trading and making 10 grand in profit, handing nearly 4 grand of it back to the government is a devastating drag on your compounding.
It is mathematical self-sabotage. However, if you hold that exact same asset for 1 year and 1 day before selling it, it is classified as a long-term capital gain. To incentivize long-term investment, the government taxes these gains at vastly lower preferential rates, typically 0, 15, or 20%, depending on your total income.
By simply possessing the patience to hold an asset for 12 months, you instantly increase your net returns by double digits. But there's one scenario where you are essentially forced to sell assets, and that is called rebalancing.
Rebalancing is the necessary maintenance of your asset allocation. Let's return to our investor who decided their ideal risk profile was 70% stocks and 30% bonds.
They set that up, and then the stock market goes on a massive 5-year bull run. The stocks double in value while the bonds just slowly tick upward.
Suddenly, the investor looks at their portfolio And because the stocks grew so disproportionately fast, stocks now make up 85% of the total portfolio value, and bonds are only 15%. Without doing anything, their portfolio is drifted into a highly aggressive, high-risk posture. If a crash happens now, they are heavily overexposed.
To fix this, they have to rebalance back to the 70-30 target, and doing so requires incredible emotional discipline.
It does, because the mechanics of rebalancing require you to sell portions of your biggest winners, the stocks that have been making you feel like a genius, and use those profits to buy more of your losers, the boring bonds that haven't done much.
It feels backwards. Why would I cut my flowers to water my weeds?
Because it mechanizes the golden rule of investing. Buy low, sell high. You are systematically locking in the gains from the asset class that has become relatively expensive and deploying that capital to buy the asset class that is relatively cheap. You are taking chips off the table when you are winning to protect yourself from the inevitable downturn.
So what does this all mean for the listener who thinks they can outsmart the IRS with constant trading? The person who sees their tech stock is down 20% in December and thinks, aha, I'll sell it to claim the massive tax loss deduction, and then I'll just buy it back the next morning so I don't miss the rebound.
The IRS closed that loophole decades ago with a mechanism called the wash sale rule.
How does it work?
The wash sale rule dictates that if you sell a stock to harvest a tax loss, and then you purchase that exact same stock or an ETF that is substantially identical within 30 days before or after the sale, the IRS completely nullifies your tax deduction. You get zero tax benefit, but you still absorb the friction costs of the trades.
If you want the deduction, you have to truly accept the risk of being out of that specific asset for a full month. Okay, so we have constructed the ideal wealth building machine. We have broad index funds, dollar cost averaging, compounded over decades, utilizing long-term capital gains, and systematically rebalanced. It is boring, and it is practically flawless.
Which is exactly why Wall Street creates complex, highly gamified traps to lure retail investors away from it. The boring path doesn't generate massive commission fees for brokers.
Let's shine a light on these shiny objects that the market uses to try and derail you. The first one is a classic, penny stocks.
Ah, the siren song of the undercapitalized beginner. Penny stocks are typically defined as shares trading dollars, representing microcap companies that are not listed on the major, highly regulated exchanges like the NYSE. They trade on over-the-counter markets.
The psychological hook is the exact same price tag fallacy we discussed, but weaponized. A beginner with $500 feels foolish buying one share of an expensive index fund. But if they find a penny stock trading at 10 cents, they can buy 5,000 shares.
And they rationalize it by thinking, if this stock just goes from 10 cents to $1, I multiply my money by 10. A 90-cent move is so easy.
But the reality is that stock is trading at 10 cents for a reason.
It is trading at 10 cents. The company is bleeding cash, drowning debt, and produced a viable product in years. Furthermore, penny stocks are incredibly illiquid. That lack of liquidity makes them the perfect vehicle for manipulation, specifically pump and dump schemes.
Explain how a pump and dump actually operates.
A group of bad actors will quietly accumulate millions of shares of a worthless 10-cent stock. Then they pump it. They blast out newsletters, flood social media message boards, and create fake hype that the company has discovered gold or cured a disease. Retail beginners see the hype and flood in, blindly buying the stock.
That massive influx of demand on an illiquid stock forces the price to skyrocket to, say, 50 cents.
Exactly. And the moment it hits 50 cents, the original bad actors dump their millions of shares onto the beginners, cashing out massive profits. The artificial demand evaporates, the truth comes out, and the stock price instantly collapses back to 5 cents. The retail investors are left holding worthless bags. Penny stocks are a mechanism for transferring wealth from the naive to the predatory.
Okay, another shiny object that traps beginners is the IPO, the initial public offering. The narrative is so compelling. Get in on the ground floor of the next Amazon before the rest of the world.
It is a brilliantly marketed illusion. An IPO is the day a private company officially lists its shares on a public exchange. But the retail investor needs to understand who the IPO is actually designed to benefit.
Right, because it's not designed as a gift to the guy trading on his couch.
Not at all. Let's look at the mechanics. A private company hires an investment bank like Goldman Sachs to take them public. The investment bank goes on a roadshow, pitching the stock to their massive institutional clients. hedge funds, pension funds, and billionaires. The bank sets an initial IPO price, say $20, and allocates those shares strictly to their elite clients.
The retail investor is completely locked out of this phase.
Entirely. Then, the morning the stock officially debuts on the NASDAQ, the hype machine has driven retail demand to a frenzy. The moment the bell rings, the retail investors rush in to buy. The price immediately pops from the $20 institutional price up to $35.
And who is selling those $35 shares to the retail investors?
The elite institutional clients who bought it at $20 the night before. They instantly flip their allocation to the retail crowd, locking in a massive, risk-free profit. The retail investor thinks they are getting in on the ground floor, but they're actually providing the exit liquidity for Wall Street insiders at a highly inflated valuation.
And the long-term data proves this is a bad deal. Researchers at the University of Florida tracked IPOs over a 5-year period and found that, on average, they underperform the broader boring market index by about 3% annually. You are paying a premium for hype during years of underperformance as the company grows into inflated valuation.
Precisely.
Speaking of paying a premium to lose money, let's talk about the two most mechanically terrifying tools a broker will offer you: margin trading and short selling. Let's start with margin. This is essentially the broker offering you a line of credit, right?
Yes. Margin is using borrowed money to amplify your position size. The broker might offer you 50% margin. If you have $10,000 of cash in your account, the broker lends you another $10,000, allowing you to buy $20,000 worth of stock.
The appeal is obvious. If I use 20 grand to buy a stock and it goes up 10%, my position is now worth $22,000. I made a $2,000 profit. But because I only used $10,000 of my own actual cash, that is a 20% return on my specific capital. I doubled the efficiency of my money.
Leverage is intoxicating when you are right, but it is a violently double-edged sword. Let's look at the downside. You use that $20,000 to buy a stock, and the company reports terrible earnings. The stock drops 20%.
Okay, so the $20,000 position is now worth $16,000, a $4,000 loss.
But remember the debt. You still owe the broker their $10,000. That debt does not shrink. So you take the remaining $16,000, pay back the $10,000 loan, and you were left with exactly $6,000.
Oh.
You started with $10,000 in cash. You lost $4,000. You suffered a 40% destruction of your net worth on a 20% market dip. Furthermore, margin is a loan. The broker is charging you high interest rates every single day you hold that borrowed money, regardless of whether the stock goes up or down. That interest acts as a constant, heavy drag on your returns.
And if the stock drops too far, the broker steps in to protect themselves. Right. The dreaded margin call.
If your account equity falls below a certain threshold, the broker will issue a margin call, demanding you deposit more cash immediately. If you cannot, the broker has the legal right to seize control of your account, forcibly sell your remaining stocks at the absolute bottom of the crash to recoup their loan, and leave you with nothing. It is how retail traders get permanently wiped out.
Margin is how you lose everything. But short selling is how you lose more than everything. Short selling breaks the fundamental logic of investing because you are trying to make money when a company fails. Explain how this physically works.
It reverses the standard timeline of a trade. Normally you buy, then sell. In a short sale, you sell first and buy later.
How do you sell something you don't own?
You borrow it. You believe a stock currently trading at $50 is a complete fraud, and it's going to crash. You ask your broker to find someone else who owns 100 shares of this stock, and you borrow those shares. You immediately turn around and sell those borrowed shares on the open market for $50 each.
Okay, so I just put $5,000 of cash in my account, but I have a giant IOU. I owe someone 100 shares of stock.
Exactly. Now you wait. If your thesis is correct, the company is exposed as a fraud and the stock price plummets to $10 a share. You go back into the open market and you buy 100 shares at the new cheap price of $10. That costs you $1,000. You take those shares, return them to the original lender, completely satisfying the IOU.
So I collected $5,000 up front, spent $1,000 to close the loop, and I walk away with $4,000 in pure profit just from watching the company burn.
Mechanically, it works perfectly. But the risk profile is terrifyingly asymmetrical. Let's analyze the absolute worst-case scenario. When you buy a normal stock for $50, what is your maximum possible risk?
$50. If the company goes bankrupt, the stock goes to zero, and I lose my initial investment. I can't lose more than I put in.
Correct. Your downside is capped at 100%. But when you short a stock at $50, you owe the lender 100 shares. There is no mathematical ceiling on how high a stock price can rise.
Oh, this is where it gets scary.
Let's say instead of crashing, the
Mm.
company you shorted gets bought out by a massive tech giant, or they announce a revolutionary patent. The stock price violently rockets from $50 up to $250.
But I still owe the lender 100 shares.
Yes. To satisfy that IOU, you are now forced to go to the open market and buy 100 shares at $250 each. You have to spend $25,000 to buy back the shares for a trade where you only collected $5,000 initially. You are personally in the hole for $20,000. And if the stock price goes to 500 or 1,000, your losses multiply toward infinity.
Your downside is literally uncapped. You can lose multiples of your entire net worth on a single bad short trade. The advice here is absolute. Beginners should never, under any circumstances, engage in short selling.
It is picking up pennies in front of a speeding steamroller. The risk is unviable.
The last trap we need to cover is more conceptual, but it devours a massive amount of beginners' time and capital. It is the allure of technical analysis. We spent time earlier discussing fundamental analysis, looking at PE ratios, reading balance sheets, understanding the actual business. Technical analysis throws all of that in the trash.
Technical analysts operate on the everything you need to know about an asset is already priced into the chart. They do not care who the CEO is, care what the profit margins are. They don't even care what the company makes. They stare at candlestick charts, volume bars, and complex overlays to try and predict future price movements purely based on historical visual patterns.
The intro promised we would demystify some jargon here. People talk of D-Day moving average is
Incredibly complex, but it's just basic arithmetic. A moving average takes the closing price of the stock over a specific number of days, say the last 50 days, adds them all up, and divides by 50 to find the average price. As each new day happens, the oldest day drops off the calculation. It creates a smoothed out line that overlays the jagged daily price chart.
And what are they trying to glean from that line?
They use it to identify trends. If the current stock price is above the 50-day moving average, they declare the stock is in a bullish uptrend. If it crosses below the line, they declare it a bearish downtrend and signal a sell.
And then there are resistance and support levels, which are just horizontal lines drawn on the chart.
A support level is a price floor. If a stock drops to $50, bounces back up, drops to 50 again, and bounces again, a technical analyst draws a horizontal line at $50 and calls it support. They assume that whenever the stock gets 50, buyers will magically appear to prop it up. Resistance is the ceiling, a price point, say $80, where the stock consistently struggles to break through because sellers dump their shares.
If resistance levels and chart patterns are just drawing arbitrary lines on a graph, why do so many people swear by them? How can a line based on what happened 3 months ago possibly predict what is tomorrow? The underlying business doesn't know there's a...
First, skepticism is entirely warranted from a fundamental perspective. However, technical analysis works just often enough to keep people hooked. And the reason it works is a fascinating psychological phenomenon. It is a self-fulfilling prophecy.
Because everyone is looking at the chart.
Exactly. You have millions of retail day traders, professional institutional desks, and algorithmic trading computers, all looking at the exact same $50 supply line. Because they all believe the line is a buy signal, they all simultaneously place massive limit orders to buy at $50.
So when the price hits 50, this tidal wave of manufactured demand hits the exchange, and it physically forces the price to bounce back up.
The line on the chart didn't predict the future. The collective, coordinated belief in the line literally engineered the future.
But relying on a self-fulfilling prophecy seems unusual. What if a terrible earnings report comes out the exact day the stock hits that support line?
The fundamentals will crush the technicals every single time. If the business line will shatter, and the technical analysts will be left holding the bag, rushing to draw a new line lower down, and they were wrong. For the long-term investor, trying to time market entries based on squiggly lines is a distraction from the only thing that actually matters: compounding capital and profitables over decades.
Which brings the absolute crescendo of this entire deep dive. If active stock picking fails, if technical analysis is financial astrology, and if our own emotions compel us to sell at the worst possible moments, who actually wins at this game?
Fidelity Investments, one of the largest brokerages on the planet, inadvertently answered this question.
Mhm.
They conducted an internal review of their massive database of retail accounts. They wanted to isolate the specific characteristics of the accounts that generated the absolute highest aggregate returns over a long-term horizon. Who were rushing the market?
Were they the day traders, the technical analysts, the people glued to the financial news networks?
It was the exact opposite. The demographic that produced the highest returns were individuals who had completely forgotten they even had a Fidelity account.
Literally forgot the money existed.
Yes. They set up an account, rolled over an old 401k, bought a few broad funds, and then lost the password. They never logged in. They never reallocated based on a geopolitical crisis. They never panic sold during a market. Only allowed the math of compound interest to run completely uninterrupted for decades.
And there is a second group in that study that's even more darkly hilarious.
Performing cohort were investors who were deceased.
Dead people beat the living.
Because a dead person can out talking head on television, scream about inflation, and subsequently log into their account to liquidate their portfolio, the dead are immune to the amygdala hijack.
It is the ultimate, undeniable proof that successful investing is a test of temperament, not a test of intellect. The absolute greatest threat to your long-term financial survival is not the Federal Reserve, it is not inflation, it is not a recession. It is your own two hands constantly trying to fiddle with the dials.
The optimal strategy is extreme boredom. Set the system up and then go live your life.
So this listener right now, holding their phone, staring at the screen, you understand the jargon now, you know how the machine works, you know what traps to avoid. We need to leave you with a concrete, uncompromising action plan. What is the very next step?
Step 1. If you have not done so, open an account with a highly reputable zero-commission, low-fee brokerage. Vanguard, Fidelity, and Charles Schwab are the industry gold standards. They're owned by the investors, not by Wall Street sharks.
Step 2. Ignore the noise. Ignore the penny stocks. Ignore the hot tips from your coworker. Utilize the ultimate cheat code by a diversified low-cost S&P 500 index fund or a total stock market index fund.
Step 3. Remove your own willpower from the equation. Set up an automated transfer from your checking account to your brokerage account to execute dollar-cost averaging every single month, regardless of what the market is doing.
Step 4. Escalate your commitment. When you start, $50 a month is fine. But when you get a raise at your job or pay off a car loan, take half of that newly freed up cash and increase your monthly automated transfer. Let your wealth-building engine scale up alongside your lifestyle.
Step 5, and this is crucial for the preservation of your sanity. Turn off the financial news, unsubscribe from the trading subreddits, delete the ticker widgets from your phone's home screen. The financial media's entire business model relies on keeping you in a state of high anxiety so you keep watching their commercials. You only need to look at your portfolio once or twice a year to rebalance.
I mean, watching, listening, and learning terms doesn't build wealth if the money's in a checking account earning 0.01% while inflation eats it.
Exactly. Every single self-made wealthy person in the market today started exactly where you are right now. Slightly confused, definitely intimidated, and worried about losing their money. The only difference between them and the people who are struggling is that they decided to take action anyway. They bought that first slice of the index fund and let the math take over.
We've spent this whole time analyzing the risk of investing in the stock market. Wait, let me rephrase that. We've spent this entire deep dive meticulously documenting the risks. Margin calls, bear markets, 30% crashes, and fees. It can still feel intimidating. But based on everything we've learned, isn't the ultimate, most devastating risk actually choosing not to invest at all?